The Nifty, India's benchmark stock market index, has taken a tumble recently, leaving investors both baffled and a tad bit bruised. The sudden drop has sent shockwaves through the financial community, causing widespread concern and anxiety among traders and investors, especially among amateurs. Like a Bollywood blockbuster gone wrong, the Nifty script seems to have flipped from a feel-good story of soaring valuations to a nail-biting thriller with an uncertain ending. The once optimistic market sentiment has turned into a suspenseful drama, with everyone on edge, waiting to see what happens next. So, what gives? Well, it's a heady cocktail of global uncertainties, domestic political dramas, and whispers of an overheated market. Trump trade war and Gaza and Ukraine war tensions, volatile oil prices, and unpredictable Trump tantrum have all contributed to the market's volatility. From Mumbai to Hong Kong, the sentiment is distinctly bearish. Investors are pulling back, wary of the potential for further declines and the impact of potential Trump trade war tantrum 2.0. The bears are out in full force, mauling any hopes of a quick market rebound. The pervasive pessimism has led to a sell-off, with many investors choosing to cut their losses rather than risk further declines. But before we hit the panic button, let's dissect the factors driving this downturn and see if there's light at the end of the tunnel. By understanding the underlying causes, we can better navigate these turbulent times and perhaps find opportunities amidst the chaos. Never one to shy away from the limelight, Donald Trump, the tweeter-in-chief, has once again sent shockwaves through global markets. His unpredictable trade wars and tariff tantrums have injected a potent dose of volatility into the system, leaving investors scrambling for cover. When Trump sneezes, the world catches a cold, or so the saying goes. And with the Chinese, European, and even US economy showing signs of a slowdown, emerging markets like India are feeling the heat. Foreign investors, spooked by the global uncertainty, are pulling out their money, putting further pressure on the Nifty. The recent market rally had all the hallmarks of a Bollywood potboiler: high political drama, soaring valuations, and a touch of irrational exuberance. But as the dust settles, some analysts are starting to question whether the Nifty had gotten ahead of itself. Key valuation metrics like the trailing 12-month price-to-earnings (TTM/PE) ratio, which compares a company's share price to its earnings per share, have been flashing red for a while now. A high PE ratio suggests that investors are paying a premium for future growth, which can be risky if those growth expectations don't materialize. In the present case of Nifty, and also Wall Street, PE ratios were hovering around 30 bubble zone just a few days ago. Normal fair PE should be around 22-20, if EPS growth around 15% to 20%. At present, average earnings growth for Nifty is around 12%, and current quarterly sequential trend and overall economic scenarios indicate around 10% EPS growth for Nifty in FY25. The market was expecting around 15 to 20% growth. Election jitters. Maharashtra and Jharkhand in focus. As the political landscape heats up, all eyes are on these two states. Adding to the market's woes is the upcoming state elections in Maharashtra and Jharkhand. The financial markets are already jittery, and the uncertainty surrounding these elections is only adding fuel to the fire. These elections are being seen as a litmus test for the ruling BJP party and could have significant implications for PM Modi's ability to push through key economic reforms. The stakes are incredibly high, and the political rallies are more intense than ever. Uncertainty breeds volatility, and the market hates surprises. Investors are on edge, and every piece of news is being scrutinized for potential impact. With no clear winner emerging from the pre-election surveys, investors are adopting a wait-and-watch approach, leading to muted market sentiment. The lack of clarity is causing hesitation among traders. The outcome of these elections could either inject some much-needed optimism into the market or send it spiraling further down. The results will be a crucial indicator of the political climate and its future direction of India. policy paralysis or prudent planning. The economic conundrum. The Indian economy, once hailed as the world's fastest-growing major economy, has hit a bit of a rough patch. The once vibrant markets and bustling streets now reflect a sense of uncertainty. Growth may have slowed down, and some critics argue that the government has been slow to react to the changing economic landscape. They point to missed opportunities and delayed reforms as contributing factors. The Modi 3.0 government, on the other hand, maintains that it is committed to fiscal prudence and is taking steps to revive the economy. Officials emphasize that their strategies are designed for long-term stability rather than short-term gains. Modinomics aimed at boosting private investment to stimulate economic activity and encourage businesses to expand their operations and creating jobs. India has a legacy issue of elevated unemployment and underemployment for its huge population. India also has sticky inflation, averaging above 5% for the last few decades, as overall supply capacity of the economy remains well below demand amid a huge population. India is now the world's most populous country, now approaching 1.5 billion population by next few years. Indian policymakers and politicians should ensure much more spending on social and traditional infra, especially in semi-high-speed railways, to compete with mighty China, rather than on competitive helicopter money or Robin Hood politics to buy votes and stay in power. India also needs political, judicial, labor, education, healthcare and land reform to become a developed economy by 2047 or even 2100. Overall, India needs to improve its productivity, which is the ultimate. India's average wage growth, 7.5%, is far higher than labor productivity growth, around 2.5%, which is also creating wage inflation as per basic economic rule. Thus, the jury is still out on whether current shape of Modinomics will be enough to get the economy back on track amid a partisan political climate. India's so-called demographic dividend is now fast turning into demographic nightmare, as educated youth unemployment is soaring to sky high amid lack of quality jobs for masses and mismatch in skill and available jobs. And increasingly, high cost of living is also affecting discretionary consumer spending and overall corporate earnings, despite high government consumption and upbeat exports. Also, RBI needs to cut rates sooner than later, as too high borrowing costs for too long is causing NPA and economic slowdown. At around 877 TTM EPS and projected 930 EPS by FY25 and 22 reasonable PE, Nifty should hover around 19,500 to 2,500 rather than 23,500 to 6,500 zone. Looking ahead, whatever may be the fundamental narrative, technically, Nifty Future has to sustain over 23,500 for any rebound to 25,000, and then lifetime high area 26,500. Otherwise, sustaining below 23,450, it may further fall to 22400 levels in the coming days.